If the IRS selected you for a single year, do not assume the audit's going to stay there. An IRS examination rarely remains confined to the years listed in the initial appointment letter. Once the IRS hits pay dirt, they ordinarily start with the original issues identified in the original audit letter. The scope often expands across years, across related entities, over to related parties, partners, family members. And once that expansion begins, the leverage shifts. The IRS does not expand audit scope randomly. Examiners are instructed to evaluate prior year tax returns, subsequent year tax returns, any related or spin-off returns, and entities that flow onto the personal return they're examining. If the facts suggest the compliance issues repeat among multiple entities in calendar years, this is where the IRS starts to test whether there's a mistake or there's a method of tax evasion at play here. And when the IRS believes the patterns may reoccur, it packages the issue. This means coordinated IDRs, cross-year comparisons, entity-level record demands, third-party cooperation. What began as a document review can quickly escalate into a criminal tax inquiry in the right circumstance. Scope expansion always intersects with statute of limitations. Generally, the IRS has 3 years to assess additional tax, but exceptions apply. If you understate your income by greater than 25%, they can expand the scope to 6 years. Listen, there's no statute of limitations at all where fraud is discovered. And there's unlimited time to audit you if no return was ever filed. The IRS can request a consent to extend the statute of limitations. This isn't clerical, it's strategic. If you sign a broad consent without negotiation, you may give the IRS more time to do the following: open additional years, add related entities, develop new issues. If you refuse the statute extension, they play hardball. They may accelerate towards some proposed assessment. I've seen them disallow all expenses and just assess on income. They'll do whatever they think they can prove at that point. Either decision invariably shapes the audit architecture. So how do related entities get pulled in? When the IRS audits a business owner, it often audits the entire ecosystem surrounding their personal return. What K-1s flow into it? What Schedule Cs are reported on it? This includes S corporations, partnerships, closely held corporations, and trusts. It can also involve related party leases, shareholder loans, payroll returns, information returns. The IRS frequently compares the entity-level books to the owner-level returns. It's only logical. They're going to compare distributions to bank deposits. They're going to compare loan balances to cash flow activity. Once third-party data enters the record, expansion becomes much easier. They're not going to trust your books when they have outside accounting they trust more. This means banks, payment processors, brokerages, payment platforms. In general, the IRS ordinarily trusts third-party data more than taxpayer data, and especially verbal explanations. So, when can civil expansion here morph into criminal exposure? Most scope expansions remain civil. However, criminal tax risk can escalate when the developing record suggests the following: affirmative acts of concealment, fabricated support, false statements, altered records, nominee ownership, inconsistent explanations across multiple years, patterns of understatement over multiple years. The shift occurs when the IRS frames the issue as criminal tax intent. After doing this work for 30 years, I can tell you the most damaging mistakes taxpayers and their representatives make usually occur after contact by the IRS begins. Improvised explanations, cleanup amendments after the fact, reconstructed documentation, uncontrolled communications by representatives that don't have attorney-client privilege. Those actions often create the evidence the government needs to criminally prosecute for tax crimes. Scope expansion requires disciplined containment. What should you do? Freeze all uncontrolled communications. You need to prevent preparers, bookkeepers, original preparers, employees, anybody from improvising narratives. You need to reconcile across multiple years and entities before you try and explain anything. You need to align bank activity with reported income. And you need to treat amendments and repairs as high risk. You need to go into any interview as if every statement will be cross-checked against third-party data. In high-risk eggshell audits, we deal with this all the time, meaning criminal referrals likely, if that type of audit is mishandled, Improperly trained and missing credentialed representatives is a problem. You need to stay away from the original preparer, as they will likely throw you under the bus to attempt to protect their own reputation. You also have to look out for California and parallel exposure. Federal scope expansion can trigger state exposure. California, for example, may follow federal adjustments when residency is implicated, California source income becomes an issue, entity flows touch California returns, and California requires reporting of any federal changes within 6 months. These things can extend the dispute in the parallel system, which means federal and state strategy must be coordinated. You need to contain this pattern early. When the IRS expands scope from 1 year to multiple years, or to multiple entities, it usually signals they have identified a tax non-compliance pattern they're not talking to you about. Once the government believes it sees a repeatable tax evasion method, your audit posture changes. You need early intervention so we can come in and control sequencing, document production, narrative framing before the IRS locks in a criminal tax intent-based theory. At the tax law offices of David W. Klossing, our dual-licensed tax attorneys and CPAs coordinate federal and California civil and criminal tax defense strategy to prevent avoidable criminal tax escalation. If your audit has expanded across multiple years or entities, or to related parties, call 1-800-681-1295 or visit klossing-associates.com to schedule a confidential reduced-rate initial consultation today. Early containment often determines whether the case stays just about money or escalates into potential criminal tax exposure. This is where we eat, live, and breathe. No client we've ever represented in a high-risk audit has ever been prosecuted for tax crimes. Thank you, David Klossing, tax attorney, CPA.